dollar, maybe.
Surprise, Jesse.
That's the culprit of all the loud barking. Yeet. Ding dong. Um, hey, what's up, Jesse? The baby here yet? No. If the baby was here, I would not be here.
You hear me, Jesse?
Yes, sir. Yeah, I heard you out there. I was just getting Finn. He's barking while my wife's trying to sleep for her shift tonight. Bias obviously long. Should probably tell my wife that I'm sharing just in case. Let me double check. Could be my webcam mic. This should sound better.
Processes at work here. One of which is the unwinding of the distortions to both supply and demand from the pandemic and the response to the pandemic, and the other is restrictive monetary policy, which is moderating demand and giving the supply side time to recover, time and space to recover. So you see those two forces now working together to bring down inflation. But it's that first one can bring down inflation without the need for higher unemployment or slower
2 and 2 up on the 5 here. Inside on the 15.
Shortages and
I am going to be looking at swings, by the way.
It's getting, a significant
Really
increase in
looking
the
at
size of the labor market,
Netflix
both from labor
440 to
participation and from immigration.
450
That's a big
calls
supply side, gain that is really helping the economy, and it's part of why GDP
for
is so big,
December.
getting that supply. So we welcome that, but I think those things will run their course, and we're probably still going to be left, we think, and I think, still be left with some ground to cover to get back to full price stability, and that's where monetary policy and what we do with demand is still going to be important.
Against that backdrop, if you've gotten any clarity on lags, if you have an economy that's been so resilient to high rate increases, does that suggest to you that there isn't necessarily this huge wave of tightening that's still coming through the pipeline and that it may have already come into effect?
I continue to think it's very hard to say. So it's been 1 year at this meeting. 1 year ago, this was the fourth of our 75 basis points hikes. So that's a full year since then. I think we are seeing the effects of all the hiking we did last year, and this year we're seeing it. It's very hard to know exactly what that might be. But you can, for example, an example of where you wouldn't have felt this yet is debt that had been termed out, but it's going to come due and have to get rolled over next year or the year after. So, and there are little things like that where the effects are just taking time to get into the economy. So I don't. I think we have to.
All right, I am long 31.75.
Under great uncertainty about how long the lags are. I think trying to get a clear answer and say, I'm just going to assume this, is really not a good way to do it. And this is one of the reasons why we have slowed the process down this year, was to give monetary policy time to get into the economy, and it takes time. We know that.
All right, 25 points right there.
So slowing down is giving.
Already taking some profits.
Of how much more we need to do if we need to do more.
Michael McKee from Bloomberg Television and Radio. I'm trying to connect the dots here. One quick clarification I want to ask about Rachel's question is, you said you need slower growth. You had always said before a period of lower than trend growth. Has that changed? And two, it sounds to me like you're basically saying here that the dot plots out the window, that every meeting is live with the possibility of a rate increase for right now. It doesn't matter about the turn of the year, and that there's not an objective way to determine whether or not you've got enough tightening in the system. It's just going to be a subjective judgment.
Q355 call 0.77.
So let's talk about the dot plot first. So the dot plot is a picture in time of what the people in the committee thinks is likely to be appropriate monetary policy in light of their own personal.
It's at 0.99, or sorry, 0.91 now.
In principle, when things change, that's not like a plan that anybody's agreed to or that we will do. That's a forecast that would change. For example,
0.97.
many things could change that would cause people to say, I wouldn't write down that dot 6 weeks later. Think of the number of things that could change your mind on that. So I think the efficacy of the dot plot probably decays over the 3-month period.
McDonald's is going down somehow.
But nonetheless, it's
being
out there.
scammed.
We do personally update our forecast, but we don't formally update the dot plot. So, I think we try to be as transparent as we can about the way we're thinking about these things.
Appreciate it, Celestial. Must have been my webcam mic. I'm on a new PC, which is actually really nice. I'm not experiencing any lag. Streaming on 2 platforms and elsewhere.
In terms of growth, what I said was below potential. So what you have here recently is growth that is temporarily potential growth.
I got an alert for Square. Probably gonna hop in those Netflix.
Trend level.
Excuse
me.
me.
The right way to think about it is what's potential growth this year. People think trend growth over a long period of time is a little bit less than 2%, or I would say just around 2%. But what we've had is with the improvement in the size of the labor force, as I mentioned, through both participation and immigration,
sorry, 450.
and with the better functioning in the labor market, and with the unwinding of the supply chain and shortages and those kinds of things, you're seeing actually elevated potential growth. There's catch-up growth that can happen in potential, and that means that if you could be growing at 2% this year and still be growing below the increase in the potential output of the economy. I hope that's clear. That's really what's going on. That's why I would say it as below potential.
But if you could clarify what I asked about meeting by
2R, let me
meeting,
make sure I got a
essentially
trim.
now supposed to assume that it's a meeting by meeting,
I did.
live meeting with a chance of a
All right,
rate
40 points. Next stop's 80.
decided on
Gonna expect that this
subjective,
breaks high day.
criteria rather than objective at each meeting.
I mean, I don't know. That
What
I
were you
like
seeing
saying
there on that
something
entry,
like
Jesse?
characters.
212 up was already established, and then it was risky selling it or buying into a 1 minute fair value gap, but it was mostly just a 1 minute break of structure. Kind of late since I didn't get in the 5 minute 212 up.
Looking at the full range of economic
I got
data,
you, thank you.
Here we are.
financial conditions and all of those things that we look at, and then we're
That dog is something special.
we come very far.
Inside bar on the 15. There it goes.
And you saw the spread at the September meeting of, it's a relatively small spread of people think 1 or 2 additional hikes. So you're close to the end of the cycle. That was an impression as of, I believe, as of September. It's not a promise or a plan of the future.
1.2 on
So
those
we're
Q
going into
calls.
these meetings one by one. We're looking at the data. As I mentioned, we're also, we're being careful. We're proceeding carefully because we can proceed carefully at this time. Monetary policy is restrictive. We see its effects, particularly on interest-sensitive spending and other channels. So that's how I think of it.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. In light of the run-up in long-term yields we've seen the last several weeks, have you given any consideration to the pace of your asset runoff program? And if there were a judgment that the higher term premium was endangering the dual mandate goals, would that be reason to think about slowing or suspending QT, or should we think of that as more of a technical question around reserves?
So, committee is not considering changing the pace of balance sheet runoff. It's not something we're talking about or considering. And I know there are many candidate explanations for why rates have been going up, and QT is certainly on that list. It may be playing a relatively small effect, although I would say at 3.3
Sorry,
trillion
YouTube. Let me
in
change this
reserves,
back
it's not,
so you guys can see my
it's hard
chart.
to make a case that reserves are even close to scarce at this point. So that's not something that we're looking at right now.
Victoria.
Square triggered 212 up on the day.
I wanted to ask about the recent
Weeklies have
recent
failed
gain
too,
on
so we have
Thursday.
full time frame
We've gotten
continuity
a lot of
there, but
pushback from people on different aspects of the proposal,
not
and
my
some
fave.
some reservations.
The
I'm
monthly's
just
still
curious,
roll. The monthly is green now.
could you accept
I don't know why it thinks the
finalizing that
monthly's red
proposal
there.
without significant changes?
Looking at a 1.5
So
trim on the
proposal is out
Qs.
for comment, and we expect a lot of comment. We won't get those comments until
Got it.
the end of, well into next year. We've extended the deadline, and we'll take them seriously. We'll read them. I'll say what I do expect is that we will come to we're a consensus-driven organization. We'll come to a package that has broad support on the board.
There's 80 points
Broad
in the
support mean
NQ
more support than the
trade.
proposal had?
Where my
means
account
broad
go over
support.
here? Delete that.
Janelle Marte with Bloomberg. So, in addition to persistence, when you look at long-term,
Be waiting for an ad here. 15 minute is 2 up.
evaluate
Target
how much
is
tighter
747
financial
here.
in the economy, and if it will lessen the need for further tightening. Also, do you think that those higher yields could affect banking stress?
So what do we look at? We look at a very wide range of financial conditions. And in fact, as you'll know, different organizations publish different financial conditions indexes, which can have 7 or 8 variables, or they can have 100 variables. So there's a very rich
Back to
environment. We
Netflix.
tend to look at a few
Iron
of
at
them. I'm not
Steel.
gonna give you the names, but they're a few of the common ones that people look at. And so they're looking at things like the level of the dollar, the level of equity prices, the level of rates, the credit spreads.
So my target here is
They're pulling in credit availability and things like that. So
Um,
it's one thing. We would
let me
never look at,
change
for
this
example,
back.
long-term treasury rates in isolation.
I think that's the one I
nor
want
would
to
we
use.
ignore them, but we would look at them as part of a broader picture, and they do play a role, of course, in many of the major standard financial condition indexes. Your
Oops,
second
wrong one.
question was
Wrong one.
banking stress. So it's something.
So we are full time frame continuity up now. To finally recognize it. So my target would be highs here. Get rid of this. I don't really care.
uninsured deposits in the March, the things we went through in March, and there. So we've been working
Target
a lot
would
with
be
financial institutions to make sure that they have,
449.89.
good funding plans and good and that they have a plan for how to deal with.
Oh wait,
the
I'm
kind of
looking at the
portfolio
wrong thing. I don't want
unrealized
that
losses
actually.
that they have. We do think the banking system is quite resilient.
Shoot,
We had, a handful of bank failures, but so that's what we're out there doing, and we don't have any reason to think that these rate hikes are materially changing that picture, which is one of a strong banking system and one where there's a strong focus by banks and by supervisors
Volumes, what I'm looking
on
at.
liquidity, on funding.
So 440, 450 is
Thanks, Mr. Chairman. Scott Horsley from NPR. Last week, you and your
305 and a 450, 460.
Swipe fees for comment.
If I can
Could you
get
just
this.
talk a little about the considerations there? What
225. I'm probably gonna do that.
Consumers, and also just
Do
what
like
y'all
a
are seeing in terms of the use of
2.37
debit and
entry.
credit cards in the payment system.
So you're right. We
All right, I got filled.
Proposal out for comment is what we did, and this is a job that Congress assigned us, as you of course know, in Dodd-Frank, and all we can really do is
Netflix
faithfully
1215,
implement the statute. That's all we're trying to
250,
do.
260.
What else
Call
can we
debit
really do?
spread.
It's a 90-day comment period. and
2.37.
typically comments once they're out for
Stop loss
and we do hope
is
that stakeholders, and we know that they will use this
405.
that.
I don't know.
So that's
Stop loss
critical, and that's-
would be
that's what I
probably
would say about that now.
under 400.
Thank you. Thanks, Chair. Edward Lawrence with Fox Business. So over the last 3 months, the year-over-year PCE inflation was at 3.4%, core well over 3%. You've said in the past 2% remains the Federal Reserve target, but with no rate increase today, how long are we okay then with a 3% or 3% plus overall inflation?
The progress is probably
From
gonna come
across
in
the
lumps,
U.S.
but we're making progress. I think the core PCE came down by almost 60 basis points in the third quarter. So the best thing I could point you to would be the September SEP, where the expectation was that inflation by the end of next year on a 12-month trailing basis would be well into the twos, and the year after that further into the twos. So that's if you look historically, that's sort of consistent with the way inflation comes in. It does take some time, and as you get further and further from those highs, it may actually take longer time. But the good news is we're making progress, and monetary policy is restrictive, and we feel like we're on a path to make more progress, and it's essential that we do.
But you've said in the past that doing too little on interest rates could take years to fix, but the cost of doing too much could be easily fixed. How robust was the debate about this pause on the doing too little side?
That's always the question we're asking ourselves, and we know that if we fail to restore price stability, the risk is that expectations of higher inflation get entrenched in the economy, and we know that that's really bad for people. Inflation will be both higher and more volatile. That's a prescription for misery, and so we're really committed to not letting that happen. For the first year or so of our tightening cycle, the risk was all on the side of not doing enough. We've come far enough that the risks have gotten more two-sided. You can't identify that with a lot of precision, but it does feel like the risks are more two-sided now. But we're committed to getting inflation back down to our target over time, and we will.
Simon Urbinovich with The Economist. Quick follow-up to the question about banking stresses. You talked about how the banking system is resilient. Of course, part of the resilience of the past year stems from the Bank Term Funding Program that you launched in March. Given that bond prices have not recovered, that unrealized losses are probably mounting, how likely is it that you might have to extend that program in March next year?
Good question. We haven't really been thinking about that yet. It's November 1, and that's a decision we'll be making in the first quarter of next year.
Okay. Sorry, quick separate question about inflation expectations. The Michigan Sentiment Survey showed a big jump in 1 year ahead inflation expectations last month from 3.2 to 4.2. Last year, you said that particular survey was a really decisive factor in one of your rate hike decisions. If it stays elevated next time around, how big of an input will that be into your December thinking?
Yeah, we look at a range of things. I think the thing got blown out of proportion a little bit. It was actually a preliminary estimate that got revised away, and I said it was preliminary but that didn't get picked up. So we look at many things. I mean, so really look across the broad array of surveys and also market-based estimates, and we do that really carefully at every meeting and between meetings. And it's just clear that inflation expectations are in a good place. The public does believe that inflation will get back down to 2% over time, and it will. They're right. So, and there's no real crack in that armor. You can always find one reading that is a little bit out of whack, but honestly, the bulk of them are just very clear that the public believes that inflation will come down, and that's, of course, we believe that's critical in winning the battle.
Hi, Chair Powell. Megan Casella with Barron's. Thanks for taking our questions. I wanted to see if you could talk about the neutral rate. You mentioned today that you're still debating whether rates are sufficiently restrictive, and you've recently said that evidence is suggesting policy is not too tight right now. So I'm curious if you could elaborate on that at all and whether that means the neutral rate, in your view, has risen.
Yeah. So first thing to say is that it's very important. It's a very important variable in the way we think about monetary policy, but you can't identify it with any precision in real time, and we know that. So you have to just take that. You have to take your estimate of it with a grain of salt. What we know now is, within a range of estimates of the neutral rate, policy is restrictive, and it's therefore putting downward pressure on economic activity, hiring, and inflation. So we do talk about this. There's not any debate or attempt to sort of agree as a group on whether R-star has moved or not. Some people think it has. Some people haven't said that don't think it has. Ultimately, it's unknowable, and so really, again, what we're focused on is looking at the data and giving ourselves a little more time now to look carefully at the data, by being careful in our moves. Does it feel like monetary policy is restrictive enough to bring inflation down to 2% over time? That's the question we're asking ourselves. I think years from now, economists will be revising their estimates of R-star as it existed on November 1, 2023. We can't really wait for that in making policy. We have to we have to have those models and look at them and think about them, and ultimately we've got to look at the effects that policy's having, accounting for the lags, which makes it difficult.
Sorry, I was responding elsewhere.
If I could follow up on a wages point earlier.
Got nobody on today.
Outlook, but I'm curious if you have any
Morning streams must be
inflation
where it's at.
Its current level could be
Maybe people at work and such.
Overall inflation or reacceleration.
So if you look at the broad range of wages, wage increases have really come down significantly over the course of the last 18 months to a level where they're substantially closer to that level that would be consistent with 2% inflation over time, making standard assumptions about productivity over time. So it's much closer than it was. And that's true of the ECI, which is the one that we got this week. It's true of average hourly earnings and compensation per hour too. So, and all of them are kind of saying that, which is great. You have to look at a group of them because any one of them can be idiosyncratic in any given reading. So that's what you see. And so what you saw with the ECI reading was, if you look back comes out 4 times a year. If you look back a couple of quarters, you'll see it was much higher, and then it came down substantially in June. And then the September reading was more or less at the same level as the June reading. So in a way, it's just validating that decline. And it was very close to our expectations internally, too. So I think we feel good about that. Also, I would say it isn't, in my thinking, it's not the case that wages have been the principal driver.
Starting to fall back a little bit here.
So far, although I do think it's fair to say that as we go forward,
what would your stops even be this high up? Because I was thinking of making it an outside bar.
Outside bar on the 5 would probably be good. I might be tempted to hold until a close under this 1 minute break of structure fair value gap.
Hi, Nancy.
But I've taken a lot of profit already, so I'm not too worried about it.
JPow, are you now as concerned about
Or I've captured a lot, I should say.
interest rates too much as you are about getting inflation?
Yeah, I got
down
some
to
nice
2%?
ads. I added on the 15-minute inside. I added
So
on the
as I
1 minute
mentioned,
break of structure.
I think for much of the last year and a half,
And
concern was
the little
5
5-minute inside.
Nice.
not doing enough. It was not getting rates high enough in time to avoid having inflation expectations, higher inflation expectations, become entrenched. So that was the concern. I think we've reached now more than 18 months into this. You can see by the fact that we have slowed down, although that we're still trying to gain confidence in what the appropriate stance is. But you can see that we think, and I think, that the risks are getting more balanced. I'll just say that they're getting more balanced. The risk of doing too much versus the risk of doing too little are getting more closer to balance, because policy is I think clearly restrictive at 5.25% to 5.5%. That range, if you take off a mainstream estimate of the expected inflation, take 1 year inflation, you're going to see a real policy rate that is well above mainstream estimates of a neutral policy rate. Now that's arithmetic. It doesn't really, what the proof is really in how the economy reacts. But I would say that we're in a place where those risks are getting closer to being in balance.
And you said the proof is how the economy reacts. What are you looking at to be sure you're not overshooting?
Well, I think what we're looking at is, is inflation still broadly cooling? Is it sort of validating the path we saw over the summer, where inflation was clearly cooling?
Outside bar on the 5 would be pretty lit here.
Periods like that before, and there hasn't been follow through. The data have bounced back. So what are we seeing? Are we seeing, is inflation still coming down? So that's the first thing. Second thing is, in the labor market, what we've seen is a very positive rebalancing of supply and demand, partly through just much more supply coming online, and with labor demand still clearly remaining very strong. When you have the kind of job growth we've had over the last quarter, it's still very strong demand. So, and you see wage increases coming down, as we discussed, but coming down, in a kind of gradual way. I think that's what we want to see, that whole set of processes continue.
I'd like to see new highs here. I really want to get it over this 1 hour fair value gap. If we reject that, it's probably dead in the water.
You obviously saw the third quarter GDP figures, which were strong, and some economists have expected revenge spending to have fizzled out by now. So I'm kind of wondering if there's been any structural change in consumption.
I wouldn't say there's been a structural change in consumption. I would say it's certainly been strong. And so a couple of things. We may have underestimated the balance sheet strength of households and small businesses, and that may be part of it. There may be, we've been, like everyone else, trying to estimate the amount of savings that households have from the pandemic when they couldn't spend on services really at all, or in-person services. And there can still be more of that than we think, although at a certain point we're going to be getting back to pre-pandemic levels of savings. We may not be there yet. So clearly people are still spending. The dynamic has been really strong job creation, with now wages that are higher than inflation in the aggregate anyway, and that raises real disposable income, and that raises spending, which continues to drive more hiring. And so you've had that whole dynamic, and also at the same time, the pandemic effects are wearing off, so that goods availability, automobile availability is better, or was better. I think it still is. And from a business standpoint, there are more people to hire, and it's more labor supply. So the whole thing has led to more growth, more spending. and that
All
kind of
right,
thing.
probably
It's
gonna
been,
start
you know, it's been good.
transitioning
And
here
the thing is
to
we've been achieving progress on inflation in the middle of this. So it's been a dynamic. The question is, how long can that continue?
probably going to
I
transition
just think
to
this-
swings.
the existence of this second set
Just
of
let this and
factors
my call go run for a
this
little
time,
bit.
which is the unwinding of the pandemic,
I've been waiting
is
to
what makes this
until this
cycle,
afternoon to get some swings. I've been eyeing
unique, I
Square,
think, and you know, we're still learning.
ExxonMobil,
That took longer for that
Apple,
process to begin than we
AMD.
thought, and we're still learning about how it plays out. That's all we can do.
I can't believe I sold those AMD calls this morning
Thank you,
at
Chair
break
Powell.
even.
Daniel Avis from Agence
They
France.
opened down.
Just a quick
They
question
opened
following
like
up,
40% down.
um,
Now those calls are like
regards to the
200%.
Hamas conflict. You know,
Craziness.
the Fed's financial stability report said the Israel-Hamas conflict and the conflict in Ukraine pose important risks to global economic activity, including the possibility of sustained disruptions to regional trade in food, energy, and other commodities. We've had organizations like the World Bank warning of a possible surge in oil prices if the war spreads to other countries in the region. I'm just wondering how the Fed is monitoring developments in the Middle East. You mentioned they are, and just what the potential economic impact could be if the conflict does spread to other countries in the region. Thank you.
I wouldn't want to speculate too much, but I'll just say so. Really the question there is, does the war spread more widely, and does it start to do things like affect oil prices in particular, since this is the Middle East we're talking about? The price of oil has really not reacted very much so far to this. As the Fed, as the Federal Open Market Committee, our job is really to understand the economy and economic effects, and it isn't clear at this point that the conflict in the Middle East is on track to have significant economic effects. That doesn't mean it isn't incredibly important and something for people to take really important notice of, but it may or may not turn out to be something that matters to the Federal Open Market Committee as an economic body. But what the Financial Stability Report does is it calls out risks, and that's what it's doing, is calling out a risk of that. And the war in Ukraine, the same. War in Ukraine, did have immediately very significant macroeconomic.
All right, fixing a scan here, and then I'll start looking. I see that NQ's going up a little bit.
Thank you. Thanks very much.
Welcome to Closing Bell. I'm Scott Wapner here at the New York Stock Exchange. That was Fed Chair Powell after the second pause meeting in a row. No hiking of interest rates, exactly what the market was expecting, of course, with the real question heading into today, what comes next? In terms of, on that note, the statement was very similar to the past one, which led to the pause. Chair Powell saying inflation has moderated but remains well above the target of 2%. Getting there, quote, in his words, has a long way to go. Economy expanding at a strong pace, above expectations, but that the full effect of policy tightening has yet to be felt. Said they'll proceed carefully, said that at least a few times. We'll make meeting-by-meeting decisions. We'll have Jeffrey Gunlock, of course, of Double Line, as we always do, exclusively coming up in just a moment. In the meantime, let's bring in Josh Brown of Ritholtz Wealth Management. He's also a CME.
All right, Amazon was a failed 2-2.
Nice move in stocks.
That one's
Nice
gone.
drop in yields.
Intel was on the list.
I think the reaction in stocks started off as
It's
muted.
probably
There's
gone.
actually only one sector that's in the red.
Microsoft was a 2-2 up I saw today. That one's gone. These are all probably gone. It's too late in the week.
Maybe Santoli can come up with it. Tech, utilities, communications, all up more than 1%.
Yeah, those are gone. So let me try dailies.
There is no new news. Art Cashin had a note out relatively quickly once we all saw the statement. He mentions the fact that even the periods of
Tesla was a signal yesterday 2-2. Don't like the weekly. Apple failed 2 down, 2 up. I like it now that it's weekly 2 up. Keep that on the list. Google was failed 2-2. Let me clean up the drawings here. I see NQ's at 100 point trim.
They said positioning and hung up on me.
Yeah, the 10-year note, you'll just look at it at 477. That really came down today with the
See 140 points, why not?
economic data was weaker. We'll ask the legendary
A little bonus day today.
about all of that. He does join us right now exclusively to react. The CEO, CIO, co-founder of Double Line Capital. Jeffrey, it's a pleasure to have you here on Fed Day as always.
Yes, Judge, good to be back for Fed Day. Not a lot of, Josh is right, not a lot of news today. It's almost a direct repeat of the last meeting. You know, carefully, said that very early
And
on.
Qs are at 2 now.
So stocks rallying, bonds obviously rallying too. We're down now about 25 basis points. But also,
All right, back to the scans for a little bit.
Interest rates. They're not even having a discussion about it.
So what was this? Google.
Confident that they're sufficiently restrictive. So
Google I like long.
pretty much wide open for future
Green month.
meetings. And
What does
the
blue
yield
mean?
curve is completely flat.
Oh, inside up.
So it's kind of in the same mode, I think. that
Google
the
might be
Fed's
one.
tone
Let me
JPow's
throw
tone
this
was.
into the
And that's the
swings.
reason why you can rally after this brutal
Boom,
sell-off
boom, boom,
in
boom,
long
boom.
rates over the past
boom.
2-3 months. I'm glad you went there because the words may have been nearly identical. The statement certainly is
Shopify. Ooh, Shopify, yummy.
to the last meeting is the move in interest rates.
Not actionable on the weekly, but the daily 2-2 reversal and target would be $50.
Certainly more recently closer to 4.9%, though you see the drop having today. And he does acknowledge the tighter financial
I'd probably grab the monthlies for November, 50 put, 55 for $1.44.
I think that's right. The higher for longer concept has a really dark underbelly to it that I think has
Stops would be
affected
pretty
the bond
tight
market
below
over the past 6 or 8
yesterday's
weeks.
close.
And that is that the interest expense on our debt
I
is going
might
up
be
by
tempted to do the
hundreds of billions of dollars,
50-55s
and it goes up every day
on
funds rate stays at 5 and
for
3%.
December.
And if the Fed's going to raise rates a little bit more, which seems
See if
less
I get this
certain
fill.
than it was,
I did.
say, perhaps the last dot
Alright,
plot.
I'm in
Well,
Shopify.
we're gonna have a lot of interest expense. In fact, 50% of the treasuries supply in the public treasuries mature in the next 3 years. And so if rates stay at these levels, we're going to have an interest expense that goes up to $2 trillion.
Alright, I like that a lot.
The federal debt. And that's what
ExxonMobil, I'm probably looking short.
is about $2 trillion.
I might swing short overnights.
Pressure
But if that monthly candle breaks under that 14 EMA and makes the weekly back in force 2's down, probably really interested in that. I want to touch it. I want to be an AMD, but I don't want to touch it this high up. Apple's a little different. Apple. Okay, this full time frame continuity has to go.
That will be 50% of tax receipts in 5 years.
Go back to this.
Obviously, that's a really big problem. So one thing that the market has to confront is we cannot
So
sustain
Apple
interest rates and
is green on the month, touching a daily fair value gap. I might wait until tomorrow, or maybe even Friday, get something super cheap. Or at least get cheaper contracts, just in case they do reverse a little bit.
And I think we're about to go to DEFCON 2 on this situation. Because
So that's that. Let's go back to the scanner. Shopify just got in. WDC. I remember looking at this, but it's had earnings a couple days ago. Big fat failed 2 up on the week because of the earnings. Might play this back into continuity there. Let's go BP. Not interested. Coke. Not interested. MO. Maybe short. MO we'll add here.
It's almost like we're the equity holder back before the global financial crisis in a CDO squared type of financing scheme that ended up causing parts of the global financial crisis. we need interest rates to come down or we need the deficit to come down, and neither of those are happening with the Fed higher for longer and with these wars that we are intent on funding. I hear the words blank check.
MO short might be interesting. Last half hour, I see NQ's just stalling out a little bit. It's alrighty. Had a little bit of a pop there, didn't hit my trim, so no trim to be had. Just go back here.
And I also think that based on our inflation model, that the CPI is likely to come down.
Baba was on here. Airbnb was also. Not interested. Chewy, too cheap.
So I think rates can fall in the backdrop of inflation
Arm.
calm and
Not
the
interested.
economy weakening. Rates can fall, but then I think the response, and this is
Aim
my
at.
bigger picture view, which is extremely important.
Aim at bullet. Oh, aim at.
But once the reaction comes to the
Where's my
recession,
buddy?
we're going to have an absolute DEFCON 2, maybe had DEFCON 1 situation on our interest expense, because I think interest rates
Oh
are
shoot.
going to start going up.
Shopify earnings tonight.
Response that will be put in place to combat the next recession. Go ahead. I'm sorry, Judge.
No, it's okay because you, in some respects, echo the likes of the legendary investor Stan Druckenmiller, who
Probably gonna
was
keep
on the
swinging it
network
though.
this morning, who most recently said that he had bought a massive position in the 2-year.
It's really undersold.
Talking about exactly the types of things that you're looking out, the longer term charts of funding the deficit, in his words, were downright scary. So he seems to be aligned with your point of view. And I'm going to come back to you, and I'm going to come back to Stan in a moment, but I want to get to Steve Leisman, Jeffrey, who's come out of the room. Steve, the biggest surprise to you was what? It's clear to everybody, and he was explicit in his own words, JPow was.
I like XM short probably.
The bond market has done that he doesn't have to do. I mentioned where rates were on the last meeting, 434. We've been talking 4.9 of late. So that's had a dramatic impact, hasn't it?
Yeah, it has, Scott. And I want to go back to what I said on your show at noon, which is I thought there was a risk that Chair Powell would use this meeting to redirect the market towards the possibility of another rate hike. He chose.
I feel like there was another one that was more interesting short though.
But he didn't sound incredibly excited about
Cisco long could be playing for an outside week.
Yeah, we're still thinking about whether or not we ought to hike again, so that's where the bias is. But he didn't rely, as he has in the past, on the September forecast that called for an additional hike this year beyond what they've already done.
Man, AMD's still just inching up. I see NQ.
Because where we are right now on the 10-year kind of wiped out the
I might swing Apple.
that we had since the very important moment.
Apple and Cisco are kind of the big ones I'm watching right now.
So at least in the 10-year, that's gone. And I think where we're at, the idea that Jeff is saying that there's a possibility of a bond rally, what I think one of the things the bond market has been waiting for is an all-clear signal from
Apple would be probably the 180s, 175. This is actually pretty cheap.
Because of the deficit reasons, but I will say the Fed will at first not do any of that
I
stuff.
could go 180, 190s for a
being
quarter.
Said, the idea that the bond market has
180 is a little bullish.
Quite a green light,
But what about the Santa rally?
Afraid of an instant or all of a sudden red light anymore. It's really yellow going to green when it comes to getting the go signal from the Fed that at least there isn't this very strong bias to hike again. I think that was an important change in the chair's tone today.
Even so, Steve, it's striking to me that here we are some 18 months into this regime of hiking interest rates.
All right, I grabbed Apple. I'll DCA if it goes down. It is going smacking that daily fair value gap, but Apple 1215s, 180, 190 calls.
But he cannot say that they're sufficiently restrictive, which to me
2.57.
is just incredible given what they've done in a reasonably short time that they've done it.
And then let me take a look
Yeah,
at
I mean,
Cisco.
Scott, they're trying to thread a needle here. They're trying to get a soft landing here, not have a recession if they can get away with not having one. Growth has been way more resilient than any private sector or government sector.
Sitting at a pretty big spot here on NQ.
Unemployment has remained lower than people had forecast. The rebound from the pandemic has essentially defied most economic models. And I think it's fair to say, you know what, this is a very uncertain time. What he's trying to do is keep Jeff from being too happy. He doesn't want to have a bright green signal that you can go ahead and start buying that short end of the coupon curve there, the 2-year
All right,
note.
back to Cisco.
I think let me just say this way, Scott. He's happy with the way the yield curve is right now in terms of the 10-year being more restrictive, but I don't think he wants to own it. He doesn't want to be responsible for the 10-year.
Cisco could be I'd probably buy the 55s outright. I'm used to buying expensive ones.
Yeah, appreciate that, Steve. Thank you.
Yeah, I'm
As
probably
always,
just gonna do the
appreciate
55s
your
outright
quarterback.
for an
Jeff,
outside
you're
bar.
Jeff, do you want to react to what Steve Leisman just told us?
I will enter if
Yeah,
it breaks
I think
this.
he's right on. I mean, I think that somehow
15-minute
the tone
high.
seems to have changed. I feel like there's a good probability that in December, when we get dot plots, I have a feeling they're not going to be as aggressive as the current dot plot. And I also think that the shape of the yield curve is extremely unstable at this point in time. We have an absolute
Just gonna
flat as a
buy
pancake
for-
yield curve. We had that inverted yield curve of 108 basis points, 2s to 10s. That's basically completely gone. This is the classic action that one gets.
Alright, filled at 75
in
cents.
recessions. You get a yield curve that inverts, and people talk a lot about it, and like it's very inverted, but it hangs out there for a long time. One point that I've been trying to
Okay.
mentor the young people in the
Added a
investment
good
business is
little-
everything takes much longer than you think it's going to. The yield curve inverts, and everybody says, oh, we're on recession watch. No, you're not. It has to be inverted for like a year and a half, but that's already happened. And then it has to de-invert, and that has now happened. We also have the unemployment rate. While low, it is now noticeably trending higher, and it's above its 12-month moving average, and it's about to go above its 3-year moving average in the first half of next year. That's very recessionary. We also have consumer confidence, and that has started to deteriorate in terms of people's view of the present, and that's starting to close
Did I
the
get
gap
in
between
Square?
the always cautious view of the future and view of the present.
No,
These are
because
very
Square
recessionary
is
signals.
barely green. I might set an alert for like.
I think we've seen hours come down.
Let me take a
we've
look
seen,
here. What did I enter
hiring
here?
freezes,
Cisco and
now we're
Apple.
starting to see layoff announcements, not
I want to
on
add
banks and not
this
they're
Square.
out there in financial
PayPal, I
firms,
heard, is
technology
also.
firms, and I believe that's going to spread.
They all have earnings this afternoon.
We're going to get this bond rally. I think the short end is going to come down.
Square has earnings
And I
tomorrow.
hope it happens
Probably
sooner
can't touch
rather
that
than
then.
later, because we can't afford this government that we're running at today's interest rate level. It's completely unsustainable. And I always seem to agree with Stan. We seem to have that same sort of Eeyore mentality about analyzing the government's finances.
I mean, you've used words like exciting of late when talking about what it's like to be a bond investor, that you can, quote, buy a T-bill and chill. Now, you have liked the longer end at periods not that long ago.
Alrighty.
The 30-year, but are you
I'm
saying
gonna
that
keep
the
this
best
on.
way to play this
I'll bring my trailings up to 717.
Entire yield curve at this point. I think the belly will outperform.
Let me put that order in. 717 trims at 7 and 10R.
Not have as many basis points of a decline, but where the excitement
And I'll see you all tomorrow. Hope everyone has a great day. And yeah, see you guys tomorrow.
where
See you
we
guys.
buy consumer receivables like credit card receivables, or we buy